James, welcome back to the podcast.
Hey, good to be with you, Sarah.
Good to be with you as always. And today we have a really important topic, which was the news that broke this week about Wells Fargo closing its correspondent channel. Tons of stuff to unpack there. So let's start with the basics. Tell us what the news story was.
Sure. So Wells Fargo announced this week the closure of their correspondent lending channel, and that they would also be reducing their servicing footprint. And absolutely, it is very big news, but it's not necessarily surprising news. The bank has been laying off quite a few mortgage staffers for the last year. Of course, nothing unique about that either, right? This is a really tough environment. And Charlie Scharf, the CEO, has also made quite a few pointed comments about the mortgage business needing to shrink. And so I think it's really important to also remember that Wells Fargo has experienced scandal after scandal over the last few years. You may have also read that they have a $3-point-something billion CFPB settlement, some of which was mortgage. The mortgage banking side has been responsible for several of these scandals. And so that kind of brings us to the story, which is, why did they decide to exit correspondent? Correspondent is about 40% of their mortgage lending volume. And essentially, for those who don't know what it means, it's kind of originating loans with a partner. So in this case, Wells Fargo would work with a regional or community bank, and in some cases, other types of lenders, and they'll originate the loan kind of on their behalf. And executives at Wells Fargo pretty much felt that when financing large amounts of loans originated by these correspondent partners, they're effectively responsible if there are problems later on, right? Whereas if they do their own underwriting and everything in-house, they know exactly what they get because there's a standard, there are no other questions. They're not basically buying these loans from others and wondering about the process. So this is going to have, I think, a pretty significant impact in two areas. One, like I said, correspondent was about 40% of Wells Fargo's origination volume. And in particular, they've been the jumbo king for such a long time. And the correspondent channel has been really instrumental in that success. And a lot of community and regional banks have obtained excellent pricing on jumbo loans from Wells Fargo, which, as a depository, they can keep the loans on their books and they can effectively originate these loans very cheaply. So these correspondent partners now I think they're probably going to have a rough time with pricing in, these high-priced areas in which jumbos are still attractive for the local lending base if Wells Fargo is not there. And then, of course, there's also the servicing side of things. Wells Fargo is, I don't have it in front of me, but probably the fifth largest Ginnie servicer in the country in 2022. And so by dropping correspondent and not originating those loans, just by virtue of that, their pipeline is going to thin. And Wells Fargo is also going to be making asset sales, selling MSRs in the coming quarters. And that's going to further reduce the profile size, in Ginnie holdings especially. And this could also cause pricing issues in Ginnie Mae. And, the CHLA, which is a trade group consisting of small lenders, they've already come out against Wells Fargo's exit in that space. And, a lot of the banks have really not been particularly active in the Ginnie Mae market for quite some time. And this is really a side effect of the Dodd-Frank legislation from way back when. But they're not really originating enough new agency stuff anymore to offset the runoff from their portfolios. You look at JP Morgan Chase, again, similar story. Their portfolio continues to decline, and of their overall servicing portfolio, less than 2% of it is Ginnie Mae. And it's these non-banks that have really stepped in and been kind of carrying this market. But it's a tough space right now. There's a lot more risk profile in Ginnie Mae, and there are a lot of new capital requirements that the government is starting to put in place. So it's a tough space, and the exit of Wells Fargo, even if it is expected, doesn't make it any easier.
So you bring up a good point with the CHLA, saying they don't like this move, but I mean, none of the big depositories are mandated or required to do this kind of lending if they don't want to do it.
Yeah, absolutely. And Wells Fargo is essentially saying, look, we are comfortable working with our own existing borrowers, and we're not going to take on the reputational risk or the financial risk, if they deem it so. I don't see a huge amount of financial risk in this market, of course, because, these are insured by the government. But having said that, that there is definitely a difference between working with your own customers and entirely your own underwriting and not having to securitize it because you just keep it on the books. And then, you compare that to working with these products that are, in a lot of cases, originated by other lending partners, and it's a different game. And so, Wells Fargo right now, given all the scandals, all the issues that they've faced, looked around and said, I don't think there's a need for us to be the size we are in mortgage. And I think if we're looking for a comparison, it's probably Bank of America, and they were the number one lender in the land. Of course, Wells Fargo had been number one for quite some time until Rocket came, 2017, 2018. And they've been gradually shrinking, but not at the same rate as some of the other big depositories. And I think, if you talk to analysts, you talk to experts in the space, they'll tell you very, very real possibility that they end up smaller than JP Morgan Chase in the mortgage game.
So interesting. When I joined HousingWire in 2013, Wells Fargo was just still huge, right? Yeah, as far as originating mortgages. But, part of the correspondent is you think, from a competitive side, if there's a lot of correspondent business going on, well, you can see why it makes sense for a depository to be part of it. But in some ways you can see also, well, hey, this is an opportunity to kind of pull back at a time when it's going to really hurt a certain part of the lending community. And that's maybe a strategic competitive move on their part too.
Yeah. And I don't think it's a surprise to anyone that it's been really tough for everybody in the space to make money in any of these channels, whether it be retail, wholesale, correspondent. Correspondent has picked up some market share in the last few quarters. And that largely owes to the relationships that these community and smaller, typically smaller, they're not always smaller, but in most cases, smaller local regional banks have with real estate agents and, borrowers in those communities. And so, Wells Fargo exiting does represent a big opportunity for others that are in that space. And, you look around and you say, maybe US Bank, a depository competitor, might find some, some advantages now working in the correspondent channel. Mr. Cooper, PennyMac, Freedom Mortgage, they could absolutely all make some money, whether it's because Wells Fargo is leaving correspondent or it's because they're shrinking their servicing footprint. And, Freedom, Mr. Cooper, Planet Home Lending, and Lakeview in particular are increasing their Ginnie Mae MSR footprints. And so, it's going to be a pretty rocky period for everyone. But, a lot of this also has to do with just the fact that mortgage is not a very profitable business for Wells Fargo, period, right now. Whether it's doing conventional mortgages, whether it's buying, through correspondent, whether it's their own, internal jumbo originations game, it's not a good business right now. And when they're dealing with all the regulatory issues that they have, the reputational issues too, right? I mean, they're massive. I don't think any bank that, frankly, I think a lot of people believe that Wells Fargo is lucky to be alive right now. And so if shrinking that risk by taking the third largest mortgage lender in America and becoming, say, the 10th, the 15th, is the way to, preserve the whole, the entity, you're going to make that move 100 out of 100 times.
Especially because, as you said, it's not like, wow, they're making so much money in mortgage right now. Nobody is. So the cost to originate's really high. There's lots of, compliance risks. So totally understandable. You mentioned that this could weaken pricing and affect FHA borrowers, right? So what do you hear on that side? And, the fact that, Wells Fargo is one of the a big lender to communities of color and, really focused on that. So what might this mean for them?
So from the Wells Fargo perspective, we don't know for certain that they're going to be exiting FHA entirely. They have not said definitively, hey guys, we're done, we're getting out of the space. But pretty much every move they've made signals that they don't have the appetite for FHA / Ginnie, mortgage servicing. So we know that for sure. What they have said is, and I think a lot of this is due to the agreement that they have with the CFPB. They do want to increase their footprint in servicing originations for minority homeownership. That is a big part of the overall move that they're making here. And they say that they're going to be investing heavily in bringing mortgage loan officers into communities of color that are typically underserved. They have a special purpose credit program that it's been in place for a little while. I believe they sunk, well, you never quite know with the accounting whether it's really $100 million, but they said that they've deployed about $100 million into this special purpose credit program for underserved minority borrowers, in which they can basically get much better rates on refis, right? So they're offering credit for refis, and now through this special purpose credit program, bit of a mouthful there, they'll also be extending that into the purchase side as well. So whether that means you have to qualify for a conventional mortgage and then you're able to, get a few, however many basis points it is, or, a credit of $7,500 or whatever it is, toward that mortgage, I don't know. Those details still haven't really been released. And I hope that we're able to find out pretty soon, because, this would be a major initiative if they are meaningfully going into communities that have, suffered. We talk about like food deserts, right? Where there are no grocery stores in certain areas. The same goes for lending. You try to find credit opportunities in Mott Haven in the Bronx, and there are no banks there. It's not like there are a lot of mortgage brokerages or retail operations that are in a lot of these communities. They just don't go there. It's not their target audience, and because they're typically nowadays, it's mostly independent mortgage banks. They don't feel like they have to, right? Like it's a really complicated issue. But if Wells Fargo is really meaningfully going to be investing in minority homeownership opportunities, that's great. And also, like, for what it's worth, there are real, actual, legitimate opportunities. It's not just, somebody saying, oh, well, we'll do this because the government wants us to, and it's a good thing to do. Look at the demographics in this country. This is an area in which you could really make a viable, strong business line. And so if Wells Fargo, which doesn't have the best track record, according to a lot of people, in serving really any borrowers, frankly, the way they should, if they're actually making this kind of investment, kudos to them. That's great. I think that's fantastic. And a lot of these special purpose credit programs say that it's Peter Piper picked a lending program. If these are relatively new, the government hadn't really cleared the runway to make sure that, you wouldn't run afoul of other fair housing, laws. So these are relatively new, but if Wells Fargo really meaningfully invests in these channels, that could be great. That could be also a great conduit to them getting, borrowers into their overall banking pipeline. So, we'll be tracking that, certainly. But, as far as your question goes into the Ginnie Mae secondary market, that's been a really topsy-turvy market. Not a lot of MBS deals, RMBS deals in general out there. And the pricing's been particularly just big gulfs, based on yield and pricing in Ginnie right now. And if you have, one of the bigger players in the space, number 5, essentially exiting and selling a huge amount of that product all at once. It could create some additional volatility in a space that has already been, 1, not very active, and 2, just kind of all over the place when it is.
Way back in April, we, the newsroom wrote, Flavia Furlan Nunez wrote an article that said some lenders won't survive the purchase mortgage market of 2022. I look back at that article, it's such a good one. It's really looking at the kinds of mortgage bankers, the kinds of companies that might fare well coming off of this huge refi boom and the ones that are going to struggle. And then we've had follow-ups on that, based on like the consolidation is continuing and like, here's what we see it. So we all throughout 2022, your newsroom really tracked like what was happening and who the players are that are positioned best to survive this. So, with this news about Wells Fargo closing its correspondent channel and some of the other recent, what do you think the update is to that? Like who's doing well, and how does that article age when we look at it now?
Yeah, I don't want to give us too many pats on the back here. I think that we kind of nailed a lot of them. It's true that there are some companies that have been better positioned. If you already had 150, 200 LOs that have strong, close relationships with real estate agents, with, other people who are kind of close to transactions, maybe financial advisors, maybe divorce attorneys, you typically fared better, right? Because there's no incentive to refi for 90-something% of the American population. So if you had a call center business and you had people that are just, not in touch with real estate agents, who don't have their trust, who aren't, among the 3 people that they're going to recommend to their borrowers, you're kind of SOL there, right? Some of them are able to pivot. Some of them are not entirely just call center based lenders. They have maybe they work through the correspondent pipeline. Maybe they also have some broker business and, tried to woo some with good pricing or maybe good service, or maybe they try their hand at fix and flip, or maybe they try like there are all kinds of products out there. But I think by and large, when you really go back to the story, which we published in, I want to say the spring of 2022, it held up. If you weren't close to the transaction, if you didn't have deals getting fed to your LOs and you couldn't execute, you're not going to make it. And I think in a lot of cases also, you need a good, strong capital markets team, because the secondary market had been so volatile, and we've seen, I don't know how many inversions we've seen, over the last year. It's been a lot, right? And we've seen huge spreads and major changes all the time. And so you have to be really adept. If this was your first cycle, if you were the, first one to be working through these sorts of conditions, not that everybody who was in that sort of position didn't make it, but a lot of them didn't, and we know that the cuts that have been instituted, are not done. The industry has shed a lot of jobs. It will continue to shed, probably 10,000 plus jobs for the next few months, even if rates do start to come back a little bit. It's just so much more capacity than business. And, even if it's a long tail, it's going to be a tough road to hoe. So, I think that we were kind of there. I didn't have Wells Fargo, exiting, 40% of its originations business on my bingo card. Probably should have. And there are a few who have fared better than others, but like nobody's doing incredibly well. Even UWM, which is, I think was really well positioned overall, and that they have a very captive audience of brokers who, have used them as their number one for quite some time, have the cash position, have the courage, I think in a lot of ways, to really cut prices and be extremely aggressive and offer any kind of product enhancement they can, to take business from lenders, and it's a zero-sum game, right? Like that loan gets funded and it gets funded by someone. And if it's not you, again, you're SOL, right? So they've done really well in that respect, but they've had to do it by cutting margins, cutting prices. Like they're not charging a premium and getting, all the glory. It's a tough road for everybody right now. So UWM is doing well. There are a few others who have climbed the rankings, right? But it's just like the Fed give it, the Fed take away.
No, it's so true. Like reading that April article We were really focused on, yes, the refi boom is coming to an end because, rates are rising. But I don't think anybody thought in April that we were going to see the amount, the quick rise in mortgage rates that we got, or the how devastating that was going to be. Just that difference between a year's difference, 6 months difference in rates, and how that would sort of lock down the market the way that it has. So we were just looking at like, oh, purchase versus refi, and yes, rising rates, but hard to have predicted exactly how that was going to go. When we look at the 2023, we see that, definitely we think that, rates have softened. I mean, luckily they haven't gone into the 8 to 10% range, which lots of people last year were like, listen, by the end of 2022 or in 2023, we're going to see 8 to 10%, which I don't know who would be left if that was the case, but it would have been even more of a bloodbath. So at least we're looking at more of a soft landing. But to your point, we are not done yet. I interviewed Bob Brooks-Smith, the CEO of the Mortgage Bankers Association, recently, and he talked about, the first, more cuts are coming, and that the first time people cut as they look at their finances, a lot of times it's not the very deepest, because you don't want to do that until you have to. So
right, it's a human thing, right? Like you never
Yep.
want to cut as many as maybe the business tells you should, or you don't plan out the worst case scenario. You think like, okay, I'm gonna take a half measure, and it'll be painful, but maybe people are optimistic, right? Like you always think maybe part of the business will rebound in that period, and so I think it's true, and it's the sharpness of the rate hikes that really got people.
Yeah.
I think there are certainly people in the industry who have worked in a mortgage rate environment in the sixes. Like it has happened before. This is sorry to say it, but like an older industry too, right? It's not like it's populated full of like 26-year-olds who are like, yeah, I got my MBA. I know how to do this. Oh, I don't know. Yeah, I saw the movie The Big Short, but like, I don't know anything about it, right? This is generally an older audience. And it's really the sharpness and just, if you relied on refi too much, and that was like, what, 67% of originations in 2020, 2021, by and large, it was 2/3 of the game. The transition, it's a slow one because it requires trust with the real estate agent, with the deals that are coming through. And lead generation is still a very inexact science. So even if you're purchasing lead gen, from a NerdWallet or any one of those sites, like the hit rate on those is generally pretty small, right? So it takes a while and you need enough deals. You also need enough complex deals for someone to trust you in all situations. So that's always going to be a slow process. You can't just send 2 deals to somebody over the course of 2 years in 2020 and 21, in which like everybody was running a well-oiled machine, and they go through no problem, no hitch, and everybody has big savings because maybe they got some money from the pandemic, bonuses were good, everything, job growth was really good for a lot of people once, some of the issues with the initial shock of the pandemic kind of got sorted, right? But now you're thinking about totally different things. You're also thinking like, is this borrower going to be employed when this loan closes? Are they able to swing, a difference in 75 basis points if, the markets are particularly volatile by the time, we're ready to finally lock the rate? Can we sell it on the secondary market at par or better? All these questions that never really had to be dealt with. Maybe some in 2018 dealt with a little bit of this here and there, but not at the scale, not at the size. Like, so many people just like, I talk to processors, underwriters who are, one, grateful to have a job right now. And a bunch of them are like, yeah, I don't do much of anything some days. Like there's just not enough business for me to stay busy. So I try to learn new skills and pick up other things. And a lot of them are just kind of waiting for the axe to fall too, right? So it's sad to say it's still going to be a really tough market for foreseeable future. And I say this as rates are closer to 5% than they have been in probably 3 months, 4 months, right? So it's, it'll be tough.
I agree. And I mean, our lead analyst, Logan Motoshami, thinks that, rates in the fives stabilize the market? Because if they can get to the fives and be there with duration, or even the low sixes and stay there with duration, then people, feel more comfortable putting their house on the market because they're going to be the buyer of, the buyer of the next house. They're not looking at rates that are just so much more than what they've got. So we can hope for that. Fingers crossed. What else are you guys planning that our audience should know about? Either a follow-up to this or other news that you're working on?
Yeah, we definitely do have a follow-up to the Wells Fargo news coming. They're also going to be announcing their fourth quarter results on Friday. So that should give us a little bit more insight into at least how their mortgage banking operation looked in the fourth quarter. We can really only speculate right now, but expect that it was probably even further down from the third quarter. But having said that, we're also really interested in looking at kind of where the market is right now, both on the proper real estate agent brokerage side, but also for the mortgage lenders out there. And so we've heard quite a bit over the last, I'd say 3 weeks, that like business is kind of picking up. I don't want to jinx it or anything like that. But people who are like, man, I went for like months without much of anything in my pipeline. Suddenly, I had like 5 or 6 buyers who are interested. It's not like they're locking right now or anything like that, but we see signs of life. And that's hugely positive. And of course that corresponds with rates starting to come down. But it's another thing too. It's that I think sellers, they get it now. If you want to get your house sold, you need to make some concessions. Gone are the days where sellers could say like, I need you to name an elementary school after my daughter, and people are like, okay, fine, I'll do it. Like, whatever. I just need to buy this house. They're starting to come to the table and say, okay, we'll fund your temporary rate buy down, right? For a year, 2 years. We'll throw in, we'll give you a credit. Maybe, we'll buy down your rate a little bit, or, you can have all the furniture. Maybe they have good taste and they're sensible people, or they'll work with the buyer, and this isn't exclusively, it's not like everybody realizes this, right? These are markets that kind of move at their own pace and in some areas. And we do see a lot of relistings still, anywhere between 30% and hell, in some markets much higher than that, or in the 40s, where, it generally says like, you're not pricing it right. Or you're not being flexible enough. So still some hesitancy out there, but we are definitely seeing a change in seller behavior. And I think that's a really good sign, especially if you can pair that with rates finally stabilizing, whether that's in the low sixes, high to mid fives, wherever that number ends up being. But it just makes everyone's life so much easier. It also means the folks in the capital markets department can go home and have dinner with their families again. It's like maybe they'll have a little more hair by the time this is over. But yeah, it's definitely, there are certainly very encouraging signs out there. It's not all doom and gloom. But also, like, let's not pretend that suddenly things are just going to come rearing back like they did, in the good old days of 2020 and 21. I think if you can hope for whatever the slow period of 2019 was, I think, brokers, lenders, LOs, realtors, appraisers, title staffers, they would bite your hand off for that kind of market. So here's to hoping.
Here's to hoping. Well, we're gonna end on that very graphic description, but it is so true. Bite your hand off for that. That's so true. It's a dog eat dog market. Thanks so much, James, for sharing your insights and for being on here, and also just for the great work that the newsroom's doing. They're working so hard to cover this giant industry and everything that's going on here.
Cool. Well, thank you so much for having me, Sarah. I'll talk to you soon.